Hello dear students, this is Financial Management Tutorial 6. The topic is Capital Structure. Let's have a recap of our earlier tutorials. In the last 5 tutorials, you have already learned what is business finance, what is the need of finance in business firm, the meaning of financial management. You have also learned the importance of financial management and objectives of financial management. Then you learn the various financial decisions, the various factors affecting financial decisions, the concept of financial planning, objectives of financial planning, and the importance of financial planning. In today's tutorial, you are going to learn the concept of capital structure, meaning of optimum or optimal capital structure, understand the concept of financial leverage and trading on equity, impact of change in the debt equity ratio upon the earning per share. Now in simple words, capital structure, it means the composition of the capital of a business organization. So when we say composition, that means what are the varied source of capital and what is the proportion of those varied source of capital or source of fund. So that is capital structure in simple words. Capital structure refers to the mix between owners and borrowed fund for investing in the business firm. When we say owners fund, it consists of equity share capital, preference share capital, and reserves and surpluses or retained earnings. It is also referred as equity. Borrowed fund can be in the form of loans, debentures, public deposits, and such related. This may be borrowed from banks, other financial institutions, debenture holders, and public. It is also referred as debt. And since owner's fund is referred as equity and borrowed fund is referred as debt, in two words it is the capital structure. It can be also said as the debt equity. And in quantitative terms, it can be expressed as debt equity ratio. So the two ratio I have seen in the slide, that can be expressed as debt by equity and debt or debt by equity. The reason for having mix of fund in the capital structure is because of the different characteristic of the varied source of fund. Debt and equity differs in the aspects of cost and riskiness for the firm. So now let's make a comparison of debt fund and equity fund. That means the owner's fund and borrowed fund. So what are their relative merit and demerit? Now when we talk about the cost of capital, if you compare debt fund and equity fund, you will notice that the cost of debt is lower than the cost of equity for a firm. And basically, it is for two reasons. Number one, for employing debt fund, the firm have to pay a fixed rate of interest. That means irrespective of the amount of profit, the firm have to bear the same rate of interest. So as the profit goes on increasing, there is no change in the interest they're going to pay to the creditors. The second reason is interest paid on debt is deductible expense for computation of tax liability. That means before the tax is calculated, the interest is deducted from the income and therefore the tax amount it also decreases. Thus, increased use of debt is likely to lower the overall cost of capital of the firm, provided there is a condition that cost of equity remain unaffected. So Because of the use of debt in the capital composition, means in the capital structure, it has the power to reduce the overall cost of capital. So why? So already we discussed the two reasons. One is fixed rate of interest and the other is it is a deductible expense for computation of tax liability. Now this is one of the advantage of debt fund. It is one of the relative advantage of debt fund in comparison to equity fund. However, risk in business for employing debt fund is more because the payment of interest and the return on principal is obligatory for a business. So this is a relative disadvantage of debt fund in comparison to equity fund. So what is the disadvantage? The disadvantage is that the return on the principal amount, that means the payment of interest, that is an obligation for the business firm irrespective of profit or loss. Whether the business is earning profit or loss, it doesn't matter. The firm must have to pay that interest. So this is one of the risks. When if the business is not able to earn profit, then that may act as a burden on the business firm. And this is the risk associated with debt fund. Both the principal amount, that is the repayment of the principal amount, and the return, that is the interest they have to pay. Any default in payment is likely to invite liquidation of the business firm. If the business firm is not able to make that payment, that is the repayment of principal or the return, that is interest, then that may be a cause for liquidation of the business firm. Now what is liquidation? Liquidation means the business firm is going to dissolve. So dissolve means their existence will be threatened. Why existence will be threatened? Because they're not able to pay the debt, and therefore they may have to go to a such instance where they are selling their properties, they're selling their assets, and from those amount they are repaying the debt. So that is the business firm is going towards liquidation, or what we are saying is dissolution. Now the question is why capital structure is a crucial matter in financial management. So already you are getting some clue, because capital structure influences the firm value and cost of capital. If the capital structure is not chosen properly, that means if the capital mix is not good or not appropriate to the business firm, then it will hamper in achieving the objectives of wealth maximization. And also the firm need to incur high cost of capital. It affects both profitability and the financial risk of the business organization. A capital structure is said to be optimal when the proportion of debt and equity is such that it results in an increase in the value of the equity shares. That is, the risk-return combination must maximize shareholders' wealth. So as we are discussing, because of use of debt fund, the firm, that is the business firm, should gain in terms of increased earning per share. When the per share, the return or the earning will increase, then it will lead to maximization of shareholders' wealth. Now maximization of shareholders' wealth, that is the objective of financial management. And this is very important. If the capital structure, that is if the capital composition is not determined carefully, then it will hamper in achieving that objective of maximization of wealth. Now we will discuss two related concepts. to capital structure. One is called financial leverage and the other is trading on equity. Financial leverage, it means the proportion of debt fund in the capital structure. The word leverage means the capacity to increase. Now, what capacity to increase? Capacity to increase the return of the business firm or increase the earning per share. So that's why the word uses leverage. You know, lever is an instrument or it is a tool to lift a heavy object. So here in case of this financial management, here leverage is, what is the leverage? The leverage is the debt fund used in a business organization. It is argued that greater the leverage, that means higher the amount of debt in the capital composition, greater the value of the firm. Firm's value increases because of increased earning per share. So that is financial leverage, use of debt fund in the capital structure. Now, trading on equity, it refers to the increase in profit earned by the equity shareholders due to the presence of fixed financial charges like interest. So that is called trading on equity. So equity shareholders, they gain in terms of increase in earning per share because of use of debt fund. And debt fund, in debt fund there is fixed financial charges, that is interest. So interest amount remain fixed irrespective the amount of profit earned by the business organization. So as the profits goes on increasing, the equity shareholders, their earning per share also increases. Now let's understand the debt fund. It may act as a two-edged weapon, means it can work in both positive way and negative way. So the business firm need to be very careful while they're going to use or source fund from debt sources. The two situation, or you can better say it as a condition. If that condition is fulfilled, then the debt fund will act as a um, positive way, in positive way, and if the condition is not fulfilled, then it may act in negative way. Now what is the condition? The condition is that the return on investment of the business firm must be higher than the cost of debt. Now what is the cost of debt? The cost of debt is the rate of interest. Now if that condition fulfilled, then only debt fund help in increasing earning per share. So that is the positive one. Higher use of debt fund reduce overall cost of capital. So that again impact on profitability. Higher use of debt increases earning per share. So that in fact profitability. And this situation is called favorable financial leverage. Then the second situation, which is unfavorable, or which is where use of debt fund may invite some risk for the business organization, which is called unfavorable financial leverage. Now the condition is when return on investment is lower than cost of debt, that is the rate of interest, then higher use of debt fund increases the fixed financial charges of a business, and which is a situation of which is inviting financial risk for the business firm. Higher use of debt increases the financial risk of firm. The firm may have to liquidate it to pay off debt. So as we already discussed, if the firm is not able to pay the or repay the debt amount, repay the return on debt amount, then they may have to sell their assets, and whatever they gain by selling their assets, that will be used for paying off debt. So that is again inviting financial risk for the business firm. And this is a condition of unfavorable financial leverage. So if one side there is prosperity, means when debt fund able to increase earning per share, that is a situation of prosperity. And the other side, if the debt fund is reducing the earning per share or increasing the overall cost of capital of the organization, so that is a situation of inviting peril for the business firm. So this is all about capital structure, financial leverage, and trading on equity. Now in next tutorial, you will learn the calculation, or you will see the impact of changing debt equity ratio or financial leverage on earning per share. So I will show here two examples. One is favorable financial leverage and other is unfavorable financial leverage. So with this, I'm concluding today's session. Thank you.